Markets somewhat on its way to recovery right now, 24,276 on the Nifty futures. But after posting a very strong set of Q2 numbers, it's IHCL which is actually holding up well in the green. We spoke with the MD and CEO, Puneet Chhatwal. Here's a slice of his interaction with Nikunj.
We have to look at quarter one and quarter two together. We are very much within our guidance, which we said we'll do a double-digit top-line growth. And if you look at the first half, we are at 11% top line. And that's my belief that demand will continue to outpace supply. And as India grows, as India's GDP grows, as India becomes from number 5 to number 3 economy, is just the beginning of a long journey for the hospitality sector. And within that, if we are the India's largest hospitality ecosystem, we will stand to benefit. There will be headwinds like we had in Q1 with an excessive heat wave, with the code of conduct, with less wedding dates in the first quarter. But all in all, I always say a year has 365 days or 52 weeks. And within that, given our very strong, not like-for-like growth with the change in the business model, we stand very well positioned to do well.
I'll get into specifics here, but the big question which everybody in a sense is trying to understand is that all other sectors have seen a slowdown because of a decline in consumer spending, apparel, cars, even air traffic. But the hotel industry is not experiencing that. Why is that? I mean, ultimately the hotel industry or the hospitality industry is a function of consumer spend and consumer demand and how good they feel. Everything is slowing down, but hotel rooms के rate ही नीचे नहीं होते.
Rate नीचे इसलिए नहीं होता because if you actually take the values of 2008 and 9 in dollar terms, we are still lower than 2008 or 9. There's not been a real increase. In fact, there is a decrease. So a lot of the business comes from outside of India. A lot of business is business driven and not leisure driven. Leisure demand is for leisure destinations and maybe for of late staycations in metros. So I think given that the supply has got constrained and hotels have actually benefited. In hindsight, I must say the hotels have benefited because of COVID, because people learned to make changes to the business model, to the cost structure, both fixed and variable. And I think if you generally look at hotel sector, it will do better than it has done in the past. And everyone has tried to take out the volatility in the business to the extent possible. Some will remain, and obviously second half is very strong. Q3 was, is, and will always remain the strongest quarter, followed by Q4 as the number 2. So I think all in all, the sector has progressed very well, and the sector is making money in Q1 and Q2, which 8-10 years ago was not the case. So I think in Q1, Q2, if you make money and Q3, Q4 comes as a bumper on top, you tend to do well, both as a sector and for us, as I said earlier, we are very well positioned to take advantage of all the possible tailwinds that we are getting.
Okay, I just want to establish this point for our viewers, and I'm going to take it up from where Mr. Chhatwal just left, which is that first half is slow, second half is better. Now, same time last year, there was an uptick of G20, and there was a lot of tailwind which has started coming because of the Cricket World Cup. Despite that, if I only look at your Q2 performance, which is for the quarter gone by, you've done well and better from last year. So where is this large bump up coming from? There is no G20, yet you've done much better than last year.
Well, I think that was the skepticism a lot of analysts and journalists had, which said like, okay, this year you have G20 and you have World Cup, what will you do next year? But there is a fundamental change. That's what I've been propagating. You can't become number 5 economy of the world and aspire to become number 3, but leave all the habits as you have had as number 20 or number 25. That does not work. There may be a lag when other things catch up. So I think we're just catching up at the moment, and the real increase you will start seeing in a few years from now in terms of rates, in terms of travel, in terms of strong international demand coming into India. We are hardly at 10 million foreign tourist arrivals. This is nothing. I mean, just the city of Paris gets 25. So given our spiritual destinations, given our rich cultural heritage, given our millions of square kilometers of mountain ranges, thousands of beaches, and our, sea mass, etc. I think a lot of development will happen on this front. Look at us. We are ourselves building 2 islands in Lakshadweep, Suheli and Kadmat, and we're looking at opportunities every day to create new destinations. And there is a very strong demand for experiential tourism at a domestic front, and that's not going to stop. It may see some headwinds, as I told you before, but over longer term, and we will keep seeing that also in the short term, it's all going to benefit the entire sector.
Okay. So given that Q2 of this year was better than Q2 of last year and new hotel additions and pricing power is on your side, do you expect that the current quarter, which is Q3, is going to be significantly better than Q3 of last year?
The good news is, as I said, Q3 is the strongest quarter. So it has the highest base, but we have started very well. We have given it in our press release that the month of October saw a number north of 16% in terms of top line. That number for a very large and a very high base for us is a significant amount. And November has the highest wedding dates this year. And December with Christmas, New Year, it's usually does very, very well. And another piece of information that is very critical. Last year, Diwali was almost mid-November. I think it was 12th of November. So Dashera, Diwali, Shraddh, Navratras, all these have been already, behind us in the month of October, or let's say the first 2-3 days of November. So the next 7-8 weeks, we should have a clean run, and we should do better than last year for sure. And that's what the business on the books shows.
While it's very easy for us to relate to the domestic market, but for me, I think one hidden secret is the international occupancy. That has been a pain point for you in the past. International occupancy expanded by 600 bips to 75% with a growth of 10% in terms of room revenue. How significant is that? And could that be the delta factor, the hidden factor which will surprise everybody in next 2-3 quarters?
Well, we hope so. We have been working very hard. The majority of the increase that you see is coming from New York, which has had a very serious swing also in the month of October, where we are still struggling, not just as a hotel sector, but the entire city of San Francisco is suffering. But we are very optimistic that in the next 3 to 6 months, it will start going up again because the downfall has been arrested. It's not getting worse for the last 100 days or so. And with the US elections behind us, I think the improvement in San Francisco will come. It's a 100% owned hotel by us. There is no debt on it, but still it would help if the market improves, and that city deserves that place on the global map. Cape Town is doing very well for us. We are investing a lot of money in London, and that will start showing very positive results in a few quarters, because at the moment we are displacing more in London, and despite that we are doing well. So the Dubai properties are management contracts, and the rest is just fine. I think the challenge we have had in the past has been the US, and we have done a few good months in the US, and one of that is reflected in the last quarter, and we have started very well in the third quarter in New York.
You consciously came out of just before COVID and said, look, I'm going to make my balance sheet light, the asset light model, which you talked about, and now the snowball effect of that seems to be kicking in. But my question to you is that now that your management fee for the first time has crossed 1 billion rupee mark in a quarter, do you see a growth of 20-25% in the management fee? What's your guidance for that?
Definitely on the absolute amount, Nikunj, you're absolutely spot on. And the management fee income that we have had in this quarter used to be 5 years ago the management fee for the entire year. So I think if we get to 600 crore plus on the management fee income, which we should mathematically, and keep growing it at the rate that you have mentioned, if not 25, at least 20, then we are in a very good space, I think. But more important is the absolute amount and not just the percentage, because we are adding so many new hotels, like more than 2 hotels a month, and they're all like somehow in a startup phase for the first 18 months. So the percentage is not the key driver, is the absolute amount, and also the hedging of the capital light versus capital heavy portfolio. That balance also helps us in finding the right mix of operating leverage from the owned and growth through fee income on the capital light model.
42 properties signed, 14 opened till this year so far. At this kind of a rate of expansion in new properties, you will be running out of options. I mean, how long can you keep on adding new properties? Because there is a limit to which what market can absorb, and there are also some key properties where competition seems to be increasing their ante. What's the threshold limit beyond which you would say that, look, I want to grow, but I don't have options to grow?
Well, I think this question can be answered in two, three different ways. Number one, the pipeline in the country. Now, I'm not talking about Indian hotels, the pipeline of hotels in the country, more than 50% is in new markets. So, as an example, we had 10 airports at the time of independence, 75, India at 75 at 150. India at 2047 is going to have 300 airports. So all these new locations create new demand and new needs and wants for other related services, of which hotels is one. So that's one part of the thing, is growth coming in newer markets. The second part is through the diversification of our brandscape. If you look at 14 openings, 6 of them have come through the Ginger brand. Ginger has a capability and the capacity to grow like it has never done before, and we've just signed our 100th Ginger property with now 17 operations and 13 pipeline. But 100 for India is like nothing. This number could grow exponentially over the next few decades. So, because Ginger could be in every district capital of India, which is like more than 700 different destinations. Now comes number 3, which is very important. Nikunj, we are a net debt-free company, and we have a lot of cash that we have accumulated. And if any M&A opportunity comes our way, we will diligently check on it and use our capital also to have inorganic part of the growth, which we have not really done. We have taken over Tree of Life in the operating company, which is a good step forward with very limited amount of money. And whatever we have done up till now is always using our internal cash accruals. So we are very pleased with that strategy, keeping our capital structure the way we have wanted to, keeping our cash reserves, and still we are building on cash to take benefit of any opportunities that might come. And we still have the opportunity of leveraging our partnerships with the GIC and other related companies, whether they come from within the group or outside, to accelerate the speed of growth.
So if you're looking at growing, and at your size, it has to be a meaningful needle-moving acquisition. Can I say that even if you consider the starting point has to be an acquisition which runs into at least $500 million? Is that the area you would start looking at something?
I don't know. It depends. Just now we did one with Tree of Life. That's not even $2 million. So forget $500 million. But if should $500 million be needed, we would have our internal resources to do so. So I think that's the key. And I think today, where we are positioned, and with 10 consecutive quarters of delivering on the promise and a little bit more than what we had promised, I believe that if needed, we would have the support of all our investors and shareholders to go even for a larger opportunity.
Could be in India and that could be outside India. You open to both?
No, our focus remains Indian subcontinent. We'll have selective growth on our capital light model outside of India, but we are not going and investing outside of India as you get the highest returns here. And we will definitely not neglect growth for just the Taj brand in key gateway markets across the globe.